All right, good morning. Good to see you all. My name is Neil Cunninghams. I've been investing professionally in everything from structured credit to private equity, venture capital, crypto for 15 plus years. Pleasure to be your moderator here today. We're here to talk about Seed to Unicorn. We have a panel of excellent experts in crypto venture capital who both scale small early stage projects to very large unicorns and beyond and help their portfolio companies quite a bit. Very excited to actually let them introduce themselves. I don't know if Christopher, you want to kick off?
Hello, my name is Christopher Heimann. I'm one of the founding partners at 1KX. We started 1KX in 2018. Before 1KX, we were founders ourselves, and while we were founders, we've also raised money from external capital. And the VCs that we raised money from were actually quite decent, but we always had the feeling, that they could have had, a much bigger impact on our success than they've actually had. And so we said, okay, if we get the opportunity to launch our own VC fund in crypto, then let's really try and focus on really trying to maximize the impact that we can have on founder success. And I think so far we've done a pretty good job at that. We are mainly investing, we mainly lead seed stage tickets, but we also invest into pre-seed and Series A. Our ticket sizes usually range between 1 to 5 million, but we also invest outside of those. And we invest across the whole stack, from application platforms to middleware to consumer applications to financial applications. Basically everything that's crypto.
Hey guys, so my name is John Butelu. I'm the founder of Stake Capital Group. We've been investing in more than 200 different companies in the space. I also participated in some of the DeFi projects early days. For example, Curve Finance. I'm also the guy behind Rekt News. And so alongside of investment, we also been building different companies, different DeFi projects. And we also actively participate in DeFi governance. For example, we are the biggest voter on Morpho. We also take some quantitative strategies, build yield strategies in the market. That's it.
Awesome. So we have a lot to get through today. Let's start with the big picture. Compared with previous crypto cycles, what's different in early stage investing this time around?
I think it's completely different. I think everything really has changed. If we are looking at, the 2017 or before cycles, there were maybe 5 VCs out there in total that focus on crypto. And there were maybe, 50 investable companies per year. And so, the natural selection, etc., was a lot easier and simpler. And now you have hundreds of VCs. You have tens of thousands of companies. The game has gotten a lot more competitive. And that is kind of, really one of the main differences that I'm seeing. How about you?
Well, the market is way more mature. So what matters today is the execution velocity. It's not necessarily about the product. It's really about the distribution channel, about the design of the product. It matters of how you can execute the product on different niches, because everyone has this kind of the same ideas right now and the same way of building a product. So what really differentiates yourself is the team, experience on the market, past execution, successes. That really what can differentiate yourself. And as investment, when we look at projects, we're really looking at the team. 98% is the team, and then we look at what type of product they are building, which is very different from before. Before it was you could have a average team, like a B+, C+ team, and then an innovative product, and you will actually bet in the team. But right now, those things have changed completely. Now you bet on the team, and you look at what the type of product they are building. So we're chasing team first, and then they're looking at what type of product they're building rather than actually looking at product and what type of team that can actually execute the product.
That's really interesting. So, if you think about what matters in terms of early stage signals, you mentioned team a lot, Julian. What do you think about community in this cycle? I think community was a very big part of previous cycles. Everyone wants to look at community when talking about listing and eventually launching a token and so on. What are your thoughts on community this time around?
Yeah, community is extremely difficult. You might have a AAA team that has a perfect product, but will still fail on the community side. We've seen most of the TGE and most of the token release that they have failed over the past few years, and because the community, when you get your product live, especially with the token, it's like instant IPO, instant public listing, and then the expertise and the skills that you have to acquire by dealing with the community is way different from actually driving a business, a traditional business or product. So we're seeing today, for example, what Binance is facing, those type of community is extremely strong. So even if you have a good team, a good product, you might actually surf on the community and then your product might die. So I think the play of having your token being released immediately after having your product well executed, it can be dangerous. So what we've seen, for example, in the past, I will give the example of Morpho, is having a very good product fit, a very good executions, but still wait 2 years before releasing the token live. So they build a steady community growth, and they find a really perfect product fit before making the public listing live. And this worked pretty well for them. But usually what will happen with products, they try to rush on the TGE, try to rush on the token, because it's kind of like the snake eating his own tail. You need the community and product, community and attention to get your product above other products. But at the same time, this can actually destroy your product.
Absolutely. And you talked about product a little bit. And Christopher, I know you're actually very technical. How do you think about evaluating technology this cycle? I mean, the technology is coming. I feel like we do the same thing in crypto. We just rename certain topics. Tokenization was called something else, it's called something else. But when you're evaluating the technology itself, the product, how do you go about that? Is there anything that you've done or you're doing differently this cycle versus previous cycles?
I think I'm gonna answer something similar to what Julian said. It's technology, etc. Like all of these things, they matter a lot less. You need to really find a very strong product. You need to have a product market fit, right? You need to kind of have very strong distribution channels. Those are the things that matter these days. You can have the best technology in the world, and we're seeing this over and over, right? That teams are so proud of their technology, but they're getting smoked 100% of the time by teams that are focusing on distribution. And that is kind of the thing, where just being blind and focusing on technology is not going to help you very much. You will end up with very cool tech, yes, and we've seen this a lot, right? Super cool tech, but then the customers, they have slightly different needs, and the reality is, you probably built your technology, relatively isolated. You didn't really take in many feedback loops, from talking to customers, etc. And all of your competitors, they went out into the market and just worked on distribution from day one, and they just made it in the end.
Yeah, if I can add, actually, it's even more important in the era of AI. The technology is becoming commoditized. So everyone can have access to the best PhD in the world using ChatGPT 5. They can actually find any type of answer to almost any type of problems. So what really matters is not necessarily building the best technology ever. As being mentioned, it's actually having the best distribution channel. So today, the investment phase is way different from 2 years ago, thanks to AI, and also because the market is becoming way more mature. So now we're looking at new type of innovative ideas and new type of executions that we never seen before.
That's actually a nice segue in terms of what is the goal these days, right? So I guess an initial milestone for Web2 VC and Web3 VC, of course, was become a unicorn, get that FDV valuation to $1 billion. Is that still a relevant milestone for crypto startups? People think about TGE. Teams change after TGE. We've seen that a lot in the last couple of cycles. What's the milestone? What's the goal that you're driving towards now?
So I mean, that's kind of it's a tricky question, right? Because in public markets, right, in equity markets, right, your goal is to like eventually like IPO, right? Like put the company on like much broader shoulders. But in crypto, like you are like launching a token, essentially like you're going public so much earlier. And most of the times, like the companies are not nearly like ready to do that, right? And so what we are always kind of like telling projects is, like number one, make sure that you have like PMF, right? I mean, like without PMF, like don't even think about launching a token unless it's like a meme coin or something like that, right? Then the second thing is you need to make sure that you have enough capacity in your team, because just kind of like maintaining like a live token is just going to really change the day-to-day priorities a lot. We'll kind of have like very different like priorities, and if you don't kind of like pay attention to them, then your token will bleed to zero, right? So you really need to have like enough capacity to kind of like really maintain all of like the capital markets function, the capital formation functions, investor relations, on like a day-to-day basis with your team. And like once you have all of those ingredients, then you wait for the right narrative. Then you wait for the right moment, and then you launch your token. That is kind of like for me like the best ingredient for success in token launches. But yeah, like the unfortunate reality is like that a lot of projects like they are just struggling with like finding any funding or like follow-on funding. And so they are opting, to just launch a token or via platforms like Pump.Fun, etc., and like get their runway from these kind of like platforms. And I guess that can work. I just haven't really seen it for products.
That's fair. Julian, just any thoughts on what the goal, the milestone should be for early stage founders?
Well, the goal in traditional finance is the IPO, right? So as you said, and what we've seen in the crypto space is people before having the right product fit, they get IPO. So if you look at the graph, the chart, usually the market goes down pretty rapidly. It's because I think what we will see more and more structures in crypto that are actually almost exactly the same that you find in equity ventures, like in startup ventures. Like you have a mix between equity and SAF tokens, for example, of course, but you trigger those tokens on milestones. So then you incentivize founders to stay for the long shot rather than actually incentivizing them to exit early. So if you look at the Camembert, if you look at how the tokens are being distributed to the founders and the team and the employees and also the community, it's extremely important that you find a pattern of incentivization that actually go for the long-term success of the product. It makes sense that founders, they will leave at some point because founders of phase one is never the same as founder of phase two. It's impossible. Someone that built a startup in the early days is way different from operating a startup. It makes sense. But you cannot have the founder having most of the shares by leaving the company at the exit of TGE. It doesn't work out. So normally in traditional finance, he will not be able to exercise his shares and then leave and then give it to someone that take over. We've seen it in all the big companies like Uber, Airbnb, all the biggest one. And this is what needs to happen in the crypto world if we want to have steady growth, steady executions, and very well class of founders. Because what we've seen today is like people creating a product, releasing the TGE, and then they call it a day because they can trade and exit. This will change. I think we've seen a couple of different new patterns. For example, there was a new idea from Andre Cronje. He's been doing a lot of different things, but I thought that it was kind of like a really good idea, like being able to lock the investment of VCs for the long-term success of the project and only use the yield generated from those investments to create value in the product. And people can exit at any point of time. I think this is kind of like a new idea.
That's actually really interesting. I mean, what I'd like to do now is move into early stage investing, the crypto VC playbook itself, and that's a nice segue there. I guess one thing I think you mentioned earlier, many TGEs, I think most TGEs over the last year and a half have actually failed, right? They're down 80% plus. I haven't checked in the last few weeks. Do you still recommend that your projects launch a token? The crypto token versus equity debate comes up quite often. But what are you telling your portfolio companies these days? Is it still worth launching a token?
You wanna-
Yeah, I mean, 100%, right? Like eventually, I do think, like a token is still, like a super nice incentive, liquidity, etc., like a mechanism. It's just right, you need to kind of like hit the right time, like, and most founders, like they're just, I don't know, they're not kind of like waiting for like the right signals, like, and they kind of like want to rush things. They're completely underestimating, and this is like really true for almost all of them. They're completely underestimating, like how much this will change like a company in terms of like culture and, like the actual, like day-to-day work. And, that is like something, where we're like really like urging the founders like, hey, unless you really have all of those boxes ticked and you're like 100% sure, like don't even think about, like launching a token. And then, like once you do all of those things, like it's like a 6 to 9 month process, to kind of like get everything done, right? Like with regards to like token distribution, token economics work, exchange negotiation, market maker negotiations, etc., roadshows. It's definitely like a very, very demanding time.
I think we like it or not, but everything is becoming tokenized. So I think the best way of to give a value to a company or a project is by looking at a token in the future. So I think it's not a matter of saying, oh, we should stop having tokens because most of the TGA in the past 2 years failed. It's more about how can we make those TGA not fail moving forward. And like, for example, I give the example again to Morpho, but I think the execution was really well made because they delayed the TGA. So people were able to kind of like farm or be compensated by tokens by providing liquidity to the lending market, but they couldn't actually make those tokens transferable. So they couldn't be traded for almost 2 years. So when they had the perfect market fit or product fit, then they decided to make it transferable. I think it's really a matter of what's the purpose of your token, or when do you want to launch the token, considering that you are building the product. I don't think like releasing the product immediately after releasing the token immediately after the product is actually good. You should actually, the more you will delay your token, I feel like the better is the product. I mean, this is my.
No, absolutely. And actually, both what you said makes a lot of sense. If you think about some of the deals in your portfolio right now, of course, tokenomics are very often set at the beginning, right? Then there's maybe a couple of rounds of raises, and so the framework is set, fixed supply in most cases. Are there any terms, or any general terms in how you structure these deals, in the safes, token warrants, whatever else, that you would change today to better align incentives versus what was set on day one?
Well, as I mentioned before, I think the ability to have on-chain milestones is extremely important. So I think we'll come to the concept of, okay, if TVL stays above 100 million for 6 months, then milestone number 2 is triggered. And this is actually made by an oracle somewhere. So then founders get compensated for achieving milestones. The same with the community. Of course, we've seen like normal patterns, vesting, cliff, linear vesting, linear cliff, all the different things. But if they are not correctly executed, it doesn't work out. You might have a 6 month cliff and still not a product fit, and it will still fail because people will farm and then dump. So what you want is people to have aligned incentive with the product execution and fit, so they stay they stay in the ecosystem for a long time, the long-term basis. So yeah, I think for me, what matters is really the milestone concept. I think we can really align people building, because the problem in what happened in DAOs, decentralized autonomous organizations, is usually holders of the token are anti-correlated to whatever the builders is building or the vision of the product. Because as a token holder, you have short-term, you're short-term. You want to, if you're making 2x or 3x or whatever by holding the token, you will sell it. But the founder is building the company for the long-term basis, normally. So you need to incentivize builders of the company that are there for the long term and holders that are there for the short term. And you need to find a way to have a threshold between long-term basis and short-term activities on your projects. It's extremely difficult.
Absolutely. And actually, let's move on and explore path to investor liquidity. And I think one of the key things here is actually the importance of investor relations, keeping the community apprised of what's going on and of course, managing expectations appropriately. So in today's token market, what does it take to win and sustain investor attention? I don't know, Christopher, do you want to go?
What does it take to sustain investors' attention? Yeah, I mean that's what I've kind of like a little bit alluded to, like in the beginning, right? Where I said, it's a full-time job, at least like for one person, like to basically like be constantly like in touch with investors, with market makers, with exchanges, with like liquid funds, with like with all kinds of like or like whales, right? With like all kinds of like capital deployers to just kind of like see, okay, like what are they looking for? Like what are we missing? What can we do better? And so that is kind of like one thing that I'm thinking is super important. We're seeing like far too many projects, just think, okay, we just need to hit the narrative, right? We not just need to pivot to AI and that's it, or we just need to, I don't know, hit like 100,000 users on our community. No, it has like no impact at all, right? And so you just kind of like need to really like think about this, like you need to just kind of like engineer all of this like a lot more. And yeah, that gets like more tricky, right? And that is, like where now, we're seeing investment banks, like coming into the space, like structuring DATs, etc., right? And all of that. And, we're seeing like more and more projects, right? Like really like going for them, not just, like the very big ones, but also, like the longer tail of assets going for like these types of things as well. And I mean, like the number of like hiring or job openings I've seen over like the past couple of months for like a head of capital markets across crypto companies is also like, I've never seen something like that before. It's absolutely crazy.
Actually, that's a really good question. So whose job is it within a company, an early stage company, to manage investor expectations? So you're seeing a lot of these job postings to sort of externalize it and hire another person to be specialized and focus on capital markets, public market investors once you have a token or otherwise. Should the founder be involved in that, or should it be something that you hire a specific IR person or team into? At what point in the journey should they be doing that?
Well, I think as a founder, if you're building a technological product, you shouldn't be the one responsible for dealing with the community and dealing with the TG, dealing with the token launch. I think you can oversee and manage, but you really need to have a team that is dedicated to answering community, being extremely transparent with what's happening. Because if you believe that having a couple of VC on your cap table is tough, well, wait when you have the TG and 1,000 or 10,000 of holders. There's an army of VCs, an army of people asking you questions of what's going on with the product. So I feel like today acquiring liquidity, I mean TVL, is not necessarily tough, but maintaining and having this liquidity for the long term is extremely tough. And we've seen really good projects that managed to get 2-3 billion TVL for a couple of months because people were farming the future airdrop, and within 24 hours, then they go down to 100 million. So 20x, 30x less. The opportunity cost is extremely high. So the ability to release a product, the ability to copycat projects and technological innovation is extremely easy. I mean, extremely easy. It's way easier than before. So now is how you differentiate yourself compared to people that they have the same ability as you as building products. So as we mentioned before, distribution channel, new type of partnerships, the ability to plug and play into DeFi projects. So how you connect across like interoperability, how do you connect between projects, how projects actually leverage your tool in order to sustain and survive. Oh, wow.
Hi, Julian.
Welcome,
Here
Richard.
you are.
Welcome, Richard. I don't know if you want to say 2 minutes about yourself, and we'll dive right back into investor education.
I like to do things very efficiently. So why allow 2.5 hours to get to the panel when you can allow 30 minutes? No, I had a flight cancellation this morning. So apologies for that, because all of your valuable time. I run Fabric Ventures. And you can tell maybe from my shortness of breath, I literally have run here from the airport. And we have about a dozen people, predominantly kind of ex-operators. We've backed about 150 plus projects in the last 12 years. We started more kind of generalist investors across seed in Europe when that was a very significant gap back sort of 2009, 2014. But got in sort of pretty early to backing some projects, initially alongside Pantera in 2013. So Abra, Bitstamp, Circle, some of them have gone well, some of them have clearly gone exceptionally well. And our kind of philosophy, we come at the space as folks who saw there was a new computing stack arising that for us is this combination of truly distributed, decentralized computing, self-sovereignty for the individual and your assets and your data, and then importantly AI, which for us is the killer application for all of this. And even payments will just become a sideshow within that, future AI-driven realm of commerce and so forth. And anyway, we're super excited to be here and on the hunt for, relentless, reckless, charismatic, technically competent founders.
Welcome. Glad to have you with us. So we were just talking about the importance of path to investor liquidity, and I think one of the things Julian was talking about is preparing the audience, the token holders for it. And so maybe the next topic to really touch on here is education. What do you guys think about education assets that are must-have assets ahead of while preparing and ahead of launching a token? So these are if I think 5-10 years ago, people really cared about white papers. That was really what was talked about on crypto Twitter. And now it's much more around a few higher level topics, less deep, less in the meat and wheat of things. But what do you guys think about dashboards, research, getting narratives out there around one's new project? And maybe I'll give Richard a few minutes to breathe. I don't know, Christopher, if you want to go first.
Okay. I'm personally not 100% convinced that any of that is needed, to be honest. I've seen lots of projects, that just have nothing of that, and they're just kind of posting a screenshot of an Excel sheet and saying, yeah, this is our revenue. And, they're getting away with it. And, the pumping goes through the roof. The token goes through the roof. Obviously, right, I would recommend, everybody to do these kind of things, right? Just always, strive for doing things the right way. It's just, I'm skeptical, that they really have, meaningful impact. On on what you want to achieve with your token, and so from that perspective, work on those things, but don't expect miracles just from having dashboards or a great documentation or anything like that.
Well, it's always the same. If you're not in a top tier, you need to do more in order to show that you're willing to. You're there to actually. You're a hustler. You're there to make it. But if you're in the top tier of projects, then you don't need to actually demonstrate and show that you have good revenue, and people will build it for you. They will get to do analytics, they will build a dashboard. So all those things, they come together natively if you're really kind of succeeding. But if you are someone that go after the tier one project, then of course I believe you should actually create those things yourself. Do an analytics dashboard, connect to DeFi Llama. The game today is the attentions, right? Distribution channel attentions, and what type of team do you have? So if you're not on the top 10 or top 20 of DeFi Llama, people won't even talk to you. So this is something you need to work on. And how you work on is by building analytics, building things that people can actually utilize, API, SDK, plug and play, those different type of things. That's how you make it.
Yeah, I'm just going to echo that. I guess as kind of investors who should know about the fundamentals, I think focusing on actually having token economics and a utility to it that makes sense and being able to articulate that, wrapping a narrative about it makes sense. And of course, doing all of this blocking and tackling and having a dashboard so people can see what's going on is key. It's all of those, that substrate, plus do it with flair. because at the end of the day, and I mean, Julien used the word attention. You want attention. You've got to have a narrative that stands out from the crowd, and then it becomes ultimately very reflexive. And so that reflexivity means either you swim or you sink. There's a big dividing line between the big winners and the kind of also rans. And even if you're Revolut, who obviously have done a lot of things right, you still take time to put your logo on the top of a building, which ultimately is not really a fundamental thing. It's a kind of just a way of getting more reflexivity in your favor. So you've got to, you got to do the fundamentals, and you've got to do it with flair, and then hopefully you win.
So thank you. So we talked big picture about this cycle versus previous cycles, what investing and what founders need to see in this cycle. We talked a little bit about deal mechanics, whether tokens still relevant anymore, what it takes to really do that. I want to switch gears a little bit and talk about how you guys help your portfolio companies. So maybe we just start with a very simple, where are you most hands-on, technically, distribution-wise, otherwise? What's your preference in terms of where you add value to your portfolio companies? For the founders, prospective founders out there, I'm sure they'd love to hear.
Yeah, so I think on our side, we a bit different from the traditional VC, I would say, because I'm a founder investor, so I was and still building companies. So I ended up investing because I was talking to founders as I was building my companies. So what really different in Stake Capital is we don't invest in projects if we don't or cannot leverage the project. It's really, I think it's, of course you can invest for the upside and making a return of investment, but we will always prefer investing in product that we can utilize, leverage, or connect to our portfolio company. So for example, Morpho, we are the biggest governance voter there. Zama, fully homomorphic encryption, we plug it into Rect News, into Vault structure for anonymity, confidentiality. So every project that we actually try to work with, invest, and we talk about 200 projects. So we do approximately 5 or 6 different calls with all the portfolio company on a weekly basis. And it's like an hour and a half, and we just basically ask them, okay, how can we help you? How can we plug and play? How can we do an MVP? How can we build something that will help you, that will help us? This is basically how we help the portfolio company. And hopefully they can give you some feedback. I think we've been pretty good at doing this. Of course, we probably also failed a couple of times, but we really care about helping people, helping the portfolio company, because they're actually helping us back. That's what's important.
Similar answer like in that regard, right? So we're focusing on a lot of verticals, right, with regards to the token economics work. We're helping with investor introductions, follow on funding. We are helping with product PMF related work, and lots of kind of these types of platform activities. But what I'm convinced actually makes the biggest difference for founders is providing a sounding board to founders. There's far too many founders who don't have really a strong network of people who they can share their worries, their doubts, or their visions or strategies with, and that also understand these types of things or really care about them. And so I think you as a VC, you're in this unique position, where you really understand deeply what the founder is doing, and providing kind of this sounding board for the founder is something that I've just kind of noticed was so far really, really appreciated. And it sounds simple, sounds super simple, but you would be absolutely surprised how many of the absolute top tier VCs in the space are not doing that. They invest a big check and then they're handing you off to the platform department, and you have very little interactions with the actual investment team after that. And so it's just just being there is already kind of a very big part of the job, I think.
So I'm going to try not to bore you by repeating all of the very good things that have just been said by Julien and Christopher. That is all absolutely right, and to different degrees we attempt to do similar things. I think both Stake and 1KX are excellent firms who in their particular areas, there's a particular emphasis they do really in a world-class way. To Chris's point, much better than a lot of the bigger firms, and arguably much better than even some of the Silicon Valley firms who can comfortably sort of lean on the existing network that exists within the valley. It's very easy, for example, for people to network peer-to-peer over there because you bump into somebody in the Starbucks queue who's building the drivers you need for your next product or whatever, or something random like that happens. So I'll just pick one other area which I think is key that I've found myself doing, maybe because I'm now in my kind of fourth decade of kind of building or helping build businesses, which is thinking about organizational design and thinking about the people that slot into that organization, and thinking about the topic that shouldn't be boring but is actually essential, which is kind of governance. But not, I mean, governance can be in the community sense as well. It's tied into on-chain governance, but also, off-chain, traditional, the board governance, but hopefully not in the sense of like, let's check that you're not being criminal and siphoning off money, or haven't got conflicts, or that you're making a fair process, but rather, how do you have a governance process that is actually driving forward the strategy in a good way, and in a way that is inspiring to the rest of the organization, that is data driven, because leadership kind of starts at the top or the bottom, whichever you want to think of the organization, and if you haven't got a board and an executive team that is leading by example, you can spend decades sort of limping along with an organization that just doesn't perform so well. So I think that's another area that you can spend a lot of time on. And then helping with those key hires, how you really have a fantastic recruitment process. How do you do scoring? How do you assess people psychologically? How do you look at cultural fit? All of this stuff. And the earlier you can start doing that, in each process and in the company, obviously that's a massive leverage on the overall outcome you're going to have.
Actually, you touched on a really interesting point, Richard, which is governance. In Web2 businesses that I've invested in, of course, boards are much more regular and expected. Web3, a newer, younger concept, makes a lot of sense. A lot of what Web3 transitions into was potentially to be DAOs, where foundations, treasuries sort of take over and community can manage on a go-forward basis. I think the DAO governance model has largely flopped in many cases. I think Aave might be one of the few positive stories there as to how that continues to work. Are you guys active in DAO governance by any chance? Is that something you encourage?
I think
as
everybody
model,
is here
DAOs
to a
going
greater or
forward?
lesser degree, but I think it's been a great challenge. I agree. Do you guys want to comment first?
I mean, I think Julian probably has the most to say here. We've looked a little bit into this as well. However, the problem, right, with DAO governance is every single person, has an equal voice, and that just makes it very, very easy for people who just kind of scream the loudest, to just kind of get the most attention. And those people are not necessarily the ones who are actually having the best things to say, or the best thing for the project in mind. And it's and then a lot of the other people who actually have very good things to kind of bring forward, they're easily demotivated by all of these people screaming and yelling and demanding that their approach kind of goes forward. And so I'm a little bit disillusioned, but I'm still hopeful, but I think Julian has a lot more experience there.
Well, we participate in Aave governance, in Morpho governance, and I think about 15 different big DeFi project governance. And I call them, most of them, I mean, they have failed, but decentralized autonomous chaos rather than decentralized autonomous organizations. And as Chris mentioned, people have different incentive than the core team of the project, and it's extremely difficult to align in incentive and interest. And particularly with X and people going public, whatever type of decision you make, even if they are extremely important for the protocol, you will just get backfire. You get criticized, you get... So I think governance on chain is extremely difficult. Only two big protocols have succeeded, is Bitcoin and Ethereum. Otherwise, as projects, the more centralized control you have of your project, the better execution you have. So it's basically against decentralized organization, a decentralized governance.
Exactly, and I get just to comment on that. I've definitely been in projects, both actually trying to effectively on the board or backing them, where, as you say, the most effective path to success would be to continue to be centralized, command and control, military style, get the hell on with it. Everybody thinks either for some philosophical reason they need to be decentralized, or they're acting out a decentralization theater for the SEC and CFTC as it was, for years, thinking that might protect them. Turned out, of course, it didn't necessarily make as much difference as they thought it might at the end of the day. But that I think has created significantly suboptimal outcomes for those different projects and for the industry as a whole so far. Although the heat has come out of the digital asset treasury, should we say, fashion and listing in the US, I think that having a publicly listed node that is very commercial in outlook and that can operate on a kind of command and control centralized sort of basis is a good thing for these ecosystems, even if some aspects of the core open source is protected through a foundation, and that means it can't be entirely co-opted. I think it will deliver a better balance. There's a separate question. People were piling into DATs because they thought it was a good short-term trade for like 30 to 60 days. That's a different thing. But I think generally having listed entities is a useful part of these Web3 ecosystems.
Makes a lot of sense. I mean, if you look at Web2, you look at IPOs, look at public shares. I mean, you can have one share of this company and that one share of another, but you're actually giving a proxy to very few people anyway to sort of govern professionally to some extent possible. So in the minute that remains, let's just do a quick lightning round. Actually, I didn't share this at the beginning, but I'm actually now a founder of a very small crypto startup and just closed my seed. So I'm very keen to understand this from you guys.
You didn't call me.
Very stealth. Nobody knows what we're doing. What's one misconception you'd advise founders to drop in 2026?
Can you say again?
What's one misconception that you would advise founders to drop in 2026?
I mean, I'm seeing a lot less of those, but I hope I'm not going to see like, okay, we're building Uniswap on this new chain. And so, like basically like building X on Y. I don't know, like if this has ever worked, like really sustainably well. Those kind of things I would prefer not to see anymore.
All right, Julian?
Well, I think stop believing that having a good-looking product will make you successful, and also having a TGE will also make you successful. I mean, I usually say token fade, execution compound. So if you have a strong execution, a strong understanding of the market, you will succeed, but not by releasing a token and releasing a good-looking product, because AI is there now.
I'm going to try and marry up two different points, and it's connected to a little bit of what Julien's saying. You don't want a good-looking product. You don't want to just go and list a token. You want to actually solve, obviously, a problem. And it is so trite, and I feel like I've sat on stage saying it a million times in different contexts. But whether it's a two-person organization or literally a 222-person organization, I have seen such bad product management, as in you've got to go out and actually speak to the market, the customers, and listen to them, or don't listen to them where that is the right thing to do. It's really, really hard. You've got to do that relentlessly and try and build a product that the world actually needs. And that takes a huge amount of organizational effort. Drop your kind of love for some particular technology, even drop your love for Web3 or blockchain. Now, absolutely, it shouldn't be about that. It should be about solving a problem, and then you go the direction you need to go. But I'll connect it with something that often pops up in that context, which is privacy. Privacy, people might think privacy is, in a sense, a kind of a benefit that users want. It's not really. It's really a kind of a technical feature. And it's extremely hard to sort of sell it, other than to people who are kind of have a zealous desire for it. But I do think it's an important part of the kit bag, and I hope that we get to the point where we can start marketing privacy as a feature that solves real problems for people, rather than for privacy in itself.
Wonderful. Great advice. Thank you guys very much. It's been a lot of fun. Thank you all for listening. Give it up to our great panelists.
Thank you.
Thank you.